Hello, I'm Ted Seides, and this is Investment Management Operations. This show explores the inner workings of the most sophisticated institutions in the industry. Through conversations with executives across operations, compliance, legal, and finance, you'll hear how key operating partners run their businesses in an ever-changing and complex investment landscape. You can join our mailing list and access Capital Allocators content at capitalallocators.com.
I'm Scott McDonald, and I'm your host. My guest on today's show is Nicole Adrien. Nicole is the Chief Product Officer and Global Head of Client Relations at Oaktree Capital. If you work directly with clients and prospects, this is the conversation. Nicole discusses her career path beginnings at Goldman Sachs and how she turned a summer internship during business school into a career at Oaktree. Working with clients today is all about transparency, speed, and accuracy. We discuss how exogenous factors from the great financial crisis have shaped client demands and how Oaktree transformed its business to meet these new requirements. We discuss the continuous demand for portfolio and company information and the multiplier effect from the increasing level of sophistication within the industry. We close with how Oaktree builds new products today, what a good prospect meeting looks like, and how Oaktree hires and instills culture and values. Please enjoy my conversation with Nicole Adrien. Nicole, thanks for joining me.
Thanks, Scott. Great to be here.
I'm excited to talk about the evolution of client service, but first I want to kick it off and love to hear more about your background and how you made your way to Oaktree.
I started my career on Wall Street back in the year 2000, a very interesting time to head to Wall Street. And I began the high net worth division at Goldman Sachs. I had the opportunity to head over to the institutional equity side of the business. And in my final year at the firm, I was invited to join what's called the executive office client team. And at the time, Hank Paulson was the CEO and Lloyd Blankfein had just become vice chair. And because Lloyd came from the trading divisions, they wanted an analyst who came from that side of the firm to support the client team, work on client strategy. It was a fantastic and fascinating opportunity. And that's where I get my intro to Oaktree. Lloyd was asked to do a meeting with Oaktree executives, and I was to brief him. And that caused me to go and do research on Oaktree Capital Management. So I went to the website, I read it front to back. I looked for articles about Howard Marks and Bruce Karsh and their partners, their co-founders. And frankly, I fell in love with the company. I love the business principles. I love the investment philosophy. And I made a mental note that when I got back to Los Angeles, which is where I grew up, I decided I needed to look up Oaktree and see if I could make my way there. So I left Goldman to go to business school at UCLA. And while I was there, I was connected with Howard. A little intimidating to call Howard Marks on the phone, which was what I was instructed to do. And as Howard always does, he picked up the phone on the first ring and we had a very brief chat. And I came in to speak with our recruiting team and I landed an internship. I always joke that when I was interviewing for that internship, I was told very clearly, you can come do an internship here, Nicole, but we don't hire MBAs full-time. You won't land a full-time opportunity after this, but if you want to come and get the experience, by all means. So I decided that was a risk worth taking. I thought the Oaktree platform was a very interesting one. I knew that I'd learn a lot. So I joined in the marketing department that summer. And I spent the fall semester of my second year in business school writing a business plan and convincing Oaktree to look at this business plan and hire me back full-time to help the senior person on the West Coast cover the West Coast. And I guess I was a good salesperson because they did hire me full-time coming out of business school in 2006. And that starts my Oaktree journey.
What was the business plan about that convinced them to hire you?
Well, what I did is I looked at all the West Coast institutions with at least $500 million in assets, who was investing in alternatives, who was clearly on the verge of doing that at that time. Not everybody was investing in alts. And I laid out a plan looking at which of these institutions were already Oaktree clients, which were not, and devised a multi-step plan to figure out how we would co-cover the region. I would take on the smaller institutions. The senior person would continue to cover the larger ones. And together we'd try to expand Oaktree's reach and our shelf space with these investors.
Do you think that you got the job because you went that extra mile?
Probably. I was very persistent, Scott. I think I did a great job in the internship. I tried to really add value and not just use it as an opportunity to learn and get to know Oaktree, but make sure that I was adding something and helping people and bringing my contributions to the table. But then I think the business plan did help them see, in fact, how this could work because they really didn't see a place for a person at my level. I pointed a picture of, look, this is a very big region. And the investors are large, they're small, they're medium-sized. And with two people, we can do a lot more than with one. So I think it was a compelling picture.
So maybe paint a picture of what was Oaktree like then and what were you doing there?
At that time, we were really growing our business. I think at that time, Oaktree only had $20 billion under management. Today, we have over $190 billion under management. We had far fewer investors. We were growing our platform, adding strategies, typically what we call step out. So taking a strategy we were very good at and finding adjacencies where we could do something new. And we really had a tremendous opportunity ahead of us. Oaktree has just been an incredible success story. At the time of the global financial crisis, which started just a year after I joined, that was one of our most important growth periods as a firm. We didn't know it, but we were on the precipice of one of the largest distress cycles in history. And that would bring tremendous opportunity to Oaktree because that's our specialty, our bread and butter, if you will.
What was the role that you started at?
So my first role at Oaktree was as a marketing representative. That's what we call our distribution people here, people who are responsible for developing and building the institutional limited partner relationships that the firm has, the investor base, essentially, clients committing their capital to our funds and partnering with us in the investment landscape.
And you've had a number of different roles. Tell us about your journey to where you are right now.
What's funny, Scott, is when I wrote my business school essay, this was the year 2004, they asked in that, what's your 5 to 10 year career plan? And I have the essay. I haven't looked at it in a long while, but I remember writing that my long-term career goal was to head a marketing department for an institutional asset management firm. So I'd always had my sights set on marketing. So I was obviously unbelievably excited to join the firm in a marketing role. But a year in, Oaktree effectuated a very interesting transaction with Goldman. We listed our stock on an over-the-counter exchange where we were able to sell about 16% of the company to a group of qualified institutional buyers. And in doing so, we committed our company to operating like a public company. And the CFO at the time asked me if I had any business school colleagues who might be able to come help him with our IR effort for this new institutional shareholder base. And I said, I definitely know some folks. Let me do some outreach. And in the meanwhile, let me help you with some of the things you're trying to accomplish. So it was an interesting inflection because we did this interesting transaction. We were heading into the GFC. We didn't know it yet. And I started working on IR projects. I'll call them the corporate side of Oaktree. And what I realized and what the CFO realized is this is really a full-time job. We need somebody to really oversee the investor relations or the corporate investor relations for the firm. So there was a bit of a fork in the road because I was moonlighting, to be honest, doing that and full-time working on the marketing side and realized I've got to make a decision here. And the CFO asked me, would you like to come do this full-time? Do you want to leave the marketing role and come work with me full-time on the corporate side? And there was the consideration of that being a departure from what I had originally set out to do, to become a marketing rep and maybe run a marketing department one day. But it was such a great opportunity because this was a new innovation and also working with the corporate side of Oaktree to work with our CFO, our then managing principal, John Frank, obviously to work very closely with Howard Marks and Bruce Karsh on the corporate side seemed like such a once in a lifetime that I couldn't pass it up. So I left the marketing seat and I became Oaktree's first head of corporate investor relations. And about, I want to say 8 months into that, GFC hit. And our managing principal realized that the house is a little bit on fire because while we were growing rapidly, having immense success, we weren't really equipped to handle all of the inbounds from our clients. And this gets into the transformation of client services and what was going on in the world, not just for Oaktree, but I'd say every asset manager. We saw a number of trends evolving, clients asking a much broader range of inquiry, demanding a lot better reporting and transparency, using consultants in a much more intense way. And this really forced us to rethink how we cover our client base. And at the time, we were raising a pretty important distress step fund, and we were realizing we weren't equipped to handle all the inbounds of the prospects, of the existing client base. So the managing partner came into my office and he said, could you be a spokesperson for our distress debt strategy? They really need help handling their own IR at their level. And he said, I imagine this will actually really help you in the corporate seat, because when I talked to the institutional shareholders of Oaktree, what did they want to talk about? They want to talk about distress. They want to talk about the environment. What was Oaktree doing? How were we approaching this evolving opportunity that was coming with this major dislocation in the financial markets? I jumped at that. That seemed like a great opportunity. So I started working with our distressed debt team. This was back in 07, 08, and learning their portfolio. Sitting in their investment team meetings, reading about the credits they were underwriting, looking at the deals they were doing, following the markets a lot more closely. And I ended up being really essentially that spokesperson to the outside. So when our marketing reps needed somebody to sit on a call with them and help a client understand what we were doing in the portfolio or how we were going to approach this evolving opportunity set, they'd bring me along so that our investment professionals could focus on their number one job of investing. They were deploying $500 million a week. They had very little time to spend with clients and prospects. They were doing the right thing. But we obviously needed to take care of clients and raise the next fund. So I was really utilized in that capacity. And that, Scott, brought about a whole different role for me, which is really to become what we now call a product specialist. So that was probably my third role at Oaktree. And then that soon evolved into another role, because we realized this works. It works to have somebody who's financially savvy, speaks the investment language, can do an English to English translation of our legal documents and the strategy speak for clients that are interested in learning more. So we decided to really evolve the way we cover clients and develop a product specialist team. We created a dedicated client services group. We also created a reporting and analytics team. That was also very new for Oaktree. And that was really to respond to clients' increasing demands for better reporting and transparency. And my opportunity was to really run all of that, to stand that up, not alone. I've done it with amazing partners along the way. But we really developed this area of Oaktree, what we call today client relations, which has a product group, a diligence support team, a client services team, and a corporate communications team. And this is about 100 people today. So that's my current role in addition to being Oaktree's chief product officer.
Very interesting. So you're talking to clients, meeting their needs, but also trying to stay on top of the investment process. How does that feedback loop work at Oaktree?
I say our product specialists spend 50% of their time with the investment team. And that's how they do it. They're in their investment committee meetings. They often sit in industry reviews. They spend a lot of their time reading about the deals that the team is doing, sometimes even diving into the financial models to really understand the valuation and creation value of some of these companies that we're investing in, or even platforms we're creating, or whatever it be. And by doing that, the other 50% of their time they're really spending with clients, and they're able to really convey and communicate what's happening and why we're doing things and how we're doing things. And it's really an effective model. And most large institutional asset managers have a role like this. Some call it the investment specialist, the product strategist, portfolio specialist. And it really works well to have, I think, somebody who's, again, savvy, has investment acumen, is numerate, but who's frankly a strong communicator. Those are the combination of skills I tend to look for, really, is how interested and savvy is somebody when it comes to the topic of investing. Have they invested before? A lot of the people I hire come from Wall Street, from leveraged finance or trading desks, where I know they've got really good technical skills, but where their passion and their real strength is in communication.
How has it been different with the LP base? Because you have consultants and just the sheer technical capability. It feels like it's just increased over time.
We work with a lot of very sophisticated clients, limited partners in the world. And many of them work with highly sophisticated investment consultants. I joke that I should have been an investment consultant. That's been such a booming industry. From the time I joined Oaktree to now, let me share this statistic. So I think when I onboarded at Oaktree back in 06, about 3 in every 10 clients utilized an investment consultant. Now, keep in mind, when a client has a consultant, you're generally working with 2 parties to get something done. So if it's diligencing a new product, a new fund, you're answering the consultant's questions. Preferably, you're getting on the consultant's buy list. They're recommending your product to their investors. At the same time, you're getting to know the client and explaining to them what you're doing. So it's really like a double layer of diligence, if you will. Well, fast forward to today, I'd say about every 7 in 8 clients are using an investment consultant. So it's really this multiplier effect of you've got, say, 70 or 80% of your institutional buyers teaming up with a consultant to look at your products. So you're working with these 2 parties. The investment consultant's raison d'etre is to diligence, to really look under every rock, to ask all the tough questions, to really analyze in depth how a manager does what the manager does, how they're differentiated or not, the quality of their track record, the quality of their people, their back office, their front office, the whole thing. And that's just really demanding. So you've got to have a very strong front line working with those investors every day. We have an excellent marketing team, and my team, the client relations area, which I think is also excellent, going hand to hand every day with these investors and trying to be responsive and stand out somehow.
We haven't really dug into really just the snapshot on who Oaktree is. Maybe give people a little bit more color on offices, people.
I mentioned earlier, Oaktree is managing today a little over $190 billion. We manage it across 4 major asset classes: real estate, private equity, listed equities, and credit. And credit is really where our roots are. We're known for credit. We're really primarily on a sub-investment grade credit manager, and both liquid credit, but also private credit, which is obviously a growing and very exciting asset class. We've been doing this for a very long time. Oaktree was officially established in 1995, but our co-founders have been working together, some since the late 70s. We have more than 20 offices all over the world. We've got 1,100 employees today. We are a multi-jurisdiction, very global operation at this point and growing.
Turning back to the multiplier effect that you talked about, and you'd hinted on when we were preparing for this conversation, the transformation of client service. How did that come to be?
To me, it starts at the time of the global financial crisis. There were really what I'd call 5 major things happening. I call them the exogenous factors, the things happening outside of us that we had no control over, that really every other manager in the world was experiencing. And one of them was the broad and ranged and depth of inquiry, which was no surprise. The phone rang on average 5 times a day. Now it was ringing 50 times a day. Why? Well, the world was coming down. It seemed like the financial world was coming to an end, and panic ensued. Really, clients were concerned. They were seeing their peers go out of business. Some of them were seeing money just evaporate. Think about the Madoff Ponzi scheme. That was cause for concern. And I think when they saw this going on around them, the instinct was, I've got to call my manager. I've got to start digging deeper. I've got to know what's going on. I can't just sit back and wait for the quarterly report. I've got to reach out. So we started getting a lot more inbound. And I know managers like Oaktree were experiencing the same thing. So that was one trend. The second was, again, I mentioned earlier, really increased demands for better reporting and transparency. The quarterly letter and the PCAP, the partner capital account statement, those were no longer sufficient. They wanted to see risk exposures, industry exposures. They wanted to know if there were companies in the news that were announcing bankruptcies, which was happening with quite a bit of frequency. Were they exposed to that? And if so, what were we doing about it? The demands for reporting and transparency just massively increased. So that was another trend. The third was increased due diligence, and not just of new fund investments, but existing ones. And this is a really interesting one. I like to tell a story about a client of Oaktree who was a client before Oaktree was established. This is a client who had invested with Howard and Bruce pre-Oaktree. They were very happy clients. They'd write roughly $100 million checks to each of our opportunistic credit funds. And in 2007, we announced the launch of our next in series opportunistic credit fund. We sent out the notice to all the investors and said, we're coming to market with the next fund. And they wrote us an apology note. They said, we're so excited about this next fund. Unfortunately, we apologize. We're going to need to go through an extensive diligence process. We have a new board, and our regulator is demanding additional documentation for any new investment we make. So even though we know you well, we know your people, we know your track record, we know your experience, we're going to have to go through this process. And they sent us a very long RFP accompanied by a spreadsheet with, I think, 20 tabs in it, Scott. And we were just shocked because this was, again, an investor who we'd send out the PPM, and not a week later, but maybe a month later, we got their docs and everything was good to go. And all of a sudden, we needed to go through an extensive process to get them onboarded. And that was a sign of the time. It wasn't isolated to that one client. So there was this increased due diligence effort on the part of existing investors, obviously new investors. And then there was the due diligence of not just our investment track record and our investing expertise, but of how we operated the firm. So that's another trend. There was this new effort to conduct diligence on the governance structures, the way the firms were operated. This we know today as operational due diligence, the famous ODD. I think when I joined Oaktree in 2006, we probably had 5 ODD meetings in that first 12 months that I was here. Last year, we recorded an ODD library. Within 3 months, had been downloaded over 2,000 times. And that's really just the client's effort to get to know the firm at the firm level, the risk architecture, the legal framework, the compliance framework, the technology infrastructure that we operate with, the procedures, the board governance and oversight. So it's all of those topics that frankly just weren't on the radar for investors at the beginning of all of this, and that in the time of the GFC really came to the fore. And I have not seen that fade away. It's really persisted. I think there are consultants who specialize in operational diligence. And that's a transformative trend.
And how do you do that at scale? You have a lot of clients, you have consultants. I wouldn't say everyone's asking the same questions, but there's a lot of repetition in what they're looking for. How does Oaktree tackle that?
Well, we're always looking for that opportunity to scale something. So I mentioned the operational due diligence library. After doing hundreds of operational due diligence meetings every year, our client services team realized that the questions are pretty similar, client to client, consultant to consultant. Obviously, there are questions that are unique, and we'll always anticipate those and be responsive. But there was this idea that maybe we should create a library and just interview these operational leaders at Oaktree, our head of compliance, our general counsel, our CFO, et cetera, and talk with them about the subjects we know clients ask about. Let's record it and let's put a library up and offer that to our investors as the first step in their ODD. So that's one way we try to create some scale and efficiency in what can be a repetitive set of Q&A that we need to go through that our clients are interested in and we want to be responsive to. So that's one way. Obviously, getting great reporting systems in place is critical. One way that we designed our reporting back in 2009 when we first established our portfolio analysis and reporting group was, what are the 50 most common questions we get when it comes to analytics? What are the metrics that clients want to measure and keep track of quarter to quarter or month to month if it's a liquid product? And let's design a report around those. Because if you can answer the 50 most common questions with one report that goes to everybody in a particular fund, you've shut down, 80, 90% of the inbounds. So that was really important to get a great reporting regime up and running. And that was something Oaktree didn't have pre-2010. And I know we're not special. Everyone else has figured this out. But these are really critical things. And especially as a firm grows, as you acquire more investors, as you establish more strategies, products, funds, you've got to create this infrastructure.
Having done ODD on smaller managers, that's a different takeaway. You're trying to identify separation of duty risk. From my viewpoint, it's more of there's an information flow. From your perspective, what's the takeaway for organizations reviewing a large firm?
Well, you mentioned separation of duties. How do we manage conflicts? They've got to get comfortable with our conflict management approach. They're going to look at the last time the SEC came in and what the SEC found, hopefully nothing. And you got to have up to current technology. You want to have a clean bill of health from your auditor. So they're looking at all the right things, and we take it very seriously. I think having a really strong operation, we know is, I wouldn't go so far as to say it's a competitive advantage, but it's certainly more than table stakes.
And how important is transparency?
Oh, I think transparency is absolutely critical. One of our business principles is communication with clients. And we talk about how transparency is so critical to establishing trust, to building relationships with our investors. We always like to say, I love how the business principle is written. You can tell how old it is because it says something like, we want to deliver bad news by fax and good news by mail. So when was the last time you used a fax machine, Scott? But that's our MO. We want to make sure that we don't take credit for things that were maybe luck. And conversely, when there's bad news, we got to get it out quick. We've got to be fully transparent about it. And we know that that's one of the ways in which we've really established strong relationships with our clients, relationships of trust. It also goes to our mission as a firm, which is to deliver superior investment performance with the risk under control and to operate our business with the highest level of integrity.
I want to turn to building products. People come to market with stuff. There's always these ideas of build it, they will come. Can you tell me how Oaktree builds product?
Well, this is the area I probably love the most of what I do. I love investments. And to me, product development really, it comes from two places. There's the demand side, which is listening to your investors, finding out what they need, what gaps they're trying to fill. And then there's the supply side. It's what investment opportunities do we see that are very exciting that we think we should bring to our investors. So when you can marry supply and demand for something, you've got something. You've figured something out. So that's always our objective, is trying to figure out how the supply of opportunity we see matches the demand or the needs of clients. So that's what we're in the business of doing. I can give you two anecdotes. One where there's a product we developed that really stemmed from that demand side. We had heard for many years from clients that they loved our liquid credit strategies. We manage high yield bonds, convertible bonds, senior loans, emerging market debt, real estate debt, corporate structured credit, et cetera. And they said, gee, these are all great strategies. We'd love for you guys to build something where it combines it in one and you're really making relative value decisions on our behalf, tilting one way or the other based on what you see as a more attractive opportunity, perhaps geographically or perhaps by asset class. So we developed our global credit strategy. And that was back in 2017. And that was after, frankly, a couple of years of hearing this feedback from clients that they really like what we do in liquid credit, but could you build something that's really multi-asset and gives you the relative value decision-making responsibility? So we built that, and that strategy now has over 10 billion under management. And it's a product that we manage, again, with a relative value approach and as a single portfolio. With Bruce Karsh, as we say, the director of the orchestra. He manages that investment committee. The other story I have is on the supply side. We had been doing private credit for a very long time and had built expertise in a number of sectors out there, one of them being the life sciences sector, which was really starting to boom when it came to private credit because a lot of the biotech companies out there were unwilling to dilute their equity in what was a plunging equity market. Biotech valuations had peaked around the time of COVID and all of a sudden had precipitously declined. So those biotech companies, which still needed a lot of capital given their R&D spending needs and the high cost of bringing their drugs and therapies to markets, realized we've got to turn to a new source of funding. So they turned to the private credit markets, and we were able to build a really nice track record within our private credit business of doing life sciences lending deals. And having done about 20 of those successfully, we decided maybe there's demand for something more niche when it comes to private credit because everybody's doing private credit, but perhaps we can bring something unique to the market. So we took that track record and our thesis that this was going to be fed by secular tailwinds. And we went to clients and said, we're thinking about something in the private credit arena that's a lot more niche than these general products that maybe you've seen previously. And we want to do this. And that was a great success for us in terms of we were oversubscribed on our life sciences lending fund. And that's something where, again, we saw an opportunity. We built a track record and said, we think this is something compelling that clients may want to do on a specialized basis.
From your perspective, what are the common pitfalls that people run into with launching new product?
Well, sometimes there's the if you build it, they will come mentality that'll get you in trouble, as you said, thinking that just because you see an interesting supply of something, that as long as you just build it, you're good to go. Well, no, you've got to do a demand assessment. You've got to really define the contours of your product and ensure that that's going to meet the needs of your investors. So there are times where you may get overconfident. Oh, we're sure people will like this. It's such a great thing. Well, you build it and then lo and behold, nobody wants it. Or more commonly, it's not necessarily that if you've got a really great strategy, particularly if it's supported by a really strong track record, you'll probably get buyers for it, but you need to think about structural considerations. There are times when if you build something in the wrong format, investors can't do it. You need to be cognizant of tax sensitivities, jurisdictional sensitivities. There are clients who are subject to certain regulatory rules, risk retention rules. Those are really important. And those are going to require you to build your strategies within certain containers that accommodate that. So you can get the structure wrong. That's a real pitfall.
We're seeing an increase in interval funds where you have previously long dated illiquid strategies that are now going into the closed end space to give people more liquidity. How does Oaktree think about that component?
That's a good one. I think you can see there are funds out there that have been built with, I'll call it mismatched liquidity. You're providing more liquidity than the underlying assets in a strategy or fund provide. That's a problem. I think if you're going to do that, the key is proper disclosure and not just the fine print, but really making sure it's part of the marketing story, that people understand that if you're going to do an interval fund where you're providing up to, let's say, 5% liquidity a quarter, that's really on a best efforts basis, that you may have to assemble a queue to get out, that it could take time, that you're not going to take actions that will undermine the overall fund or the remaining investors by fire selling assets just to accommodate requests for liquidity. So I think it's really important to be very transparent and clear up front if you're going to build a product like that, that's how it's going to work. And that just because we're saying there's going to be quarter liquidity doesn't mean it will be liquidity on demand.
What about fees and terms, side letters, those pieces? What's the tone today?
There's been, I'd say, a lot of talk about fee compression in the investment management industry in general. Certain asset classes have become more commoditized than others. Not everything is commoditized at all. So there's different levels of pressure in different areas. Our job, and again, back to our business principles, is we really believe in fair and transparent fee arrangements. And we really believe that investors that are similarly situated should be treated the same. So we spend a lot of time on fees and terms. We try to set competitive fees and terms up front. We used to publish only an entry-level fee rate to our products. Today, we publish a fully graduated rate table, if you will, so that it's very clear to everybody what type of fee breaks you'll get for size. We think that's important. And again, transparency, fairness, competitiveness. If you want a product to be successful, it's got to be competitively priced. That doesn't mean you need to be the low-cost leader, but it does mean you need to be in market. So we're very conscientious about that. And the fee game is a tough one. Obviously, when you've got a product that's got a terrific track record, and in particular, if you're sizing your fund right, if you're not oversizing it and say there's limited supply of something, that gives you a little bit more leverage to charge a higher than market or at the top of market fee rate. So we think about that as well. But in general, fairness and transparency, those are our two guiding lights when it comes to fees.
And then what about on the data side today? What's your view on the data demand side in this market?
Always insatiable demand, let's put it that way. It seems like no matter what we put out there, clients will always want more or maybe cut a little bit differently or against a different benchmark or with a different layer of attribution or whatever. So the demands are always fast coming and we're trying to always be responsive.
One other question. So it comes on the backdrop of having been in pitches on both sides of the equation. You walk out and one person goes, that was a great meeting. And the other person goes, that's a terrible meeting. What are the components of a good meeting as a GP?
Well, let me start with advice I got from one of my earliest mentors back at Goldman. I asked him, what does it take to be a great salesperson, great client relationship manager? And this is a really successful guy. He said, I think the key is to make sure that you're more worried about being interested than interesting. And I love that. And I've kept that with me for 25 years because I know if you go into a meeting and it's just all about sharing what's in your head and all the expertise you have and all the reasons why you should put Oaktree in your portfolio, and you don't take time to understand what the client needs, what's on their mind, what things they're seeing that could be interesting and helpful to you as you develop, say, your next product idea, I can't consider that a successful meeting. So I like to start with making sure there's going to be a two-way exchange. We do go into a meeting wanting to explain something, tell a story, pitch a product, whatever, but it's really equally as important that we walk out of there understanding where our clients are at. It's an exchange of ideas. There may be things clients are seeing that we're not, and we want to be aware of that. It can make us better investors. So those are really critical components of a successful meeting. And that two-way exchange is what I think is top of the list. Strong engagement. I like when there's a person in the room who can tell that, say we've got 5 representatives from our clients across the table from us, and someone can tell that the person on the end has a question. We're all just rolling with the spiel and, hey, do you have a question? It looks like they may have wanted to interject, and making sure you're inviting those questions and that conversation. That's so important.
Coming from Goldman to Oaktree, you have a varied experience. How do you transfer that knowledge to the next generation to keep all the stuff you've learned true to Oaktree?
Well, at Oaktree, we've developed a pretty robust training, and we make that part of it. So if you join client relations at Oaktree, before you hit the desk, before you pick up the pen on anything, you're going to spend 3 weeks meeting the people you need to meet, reading the documents you need to read, training on the systems you need to train on, and really learning these protocols. And I say protocols, that sounds a little cold, but really it's how do we do what we do? It's not just what do we do, but how do we do it? So there's meeting training, there's presentation training.
What's meeting training?
There's a whole, what we call an Oaktree University, because we have Oaktree University. I think there's a 2-hour Oaktree University on the topic of what makes a great meeting. We've invited in professionals from our marketing group, from my team, some investment professionals, our vice chair, different people participate to help the next gen understand, here's what you got to be focused on in a meeting. Here are some best practices that we hope you'll adopt as you go out and do meetings yourselves. So those are important things. And then it's cultural. A lot of it is cultural. In addition to that more formal training program, we really consider ourselves an apprentice model. So people that are going to be in client meetings don't just cold go into their first client meeting. They're going to attend a number of client meetings with more experienced people and really just sit and watch and listen or be the potted plant for a long enough time until they really figure out, we want them to read the room, read the people. What do you observe about how we handled the meeting, how we handled the questions? We'll often ask new people, do you have any feedback for us? Because they may be picking up on things that we're not. So that's really important to us as well. But that's part of it. It's cultural. It's how do we train and assimilate people?
And what about presentations?
A lot of people say that, a meeting is great if you never crack the book open. I don't know if I agree with that. I think that there's a place for pages in a book to be shown. I don't believe in flipping a book page by page in a meeting. I don't think that makes a successful meeting. But the book is there for a reason. And hopefully you have the opportunity to really hit home on a few key points that we want clients to understand. And for that, the book is there. So I think knowing your book really well and knowing maybe the 3 or 4 pages that you really want to hit on and being able to say, well, actually, if we turn to page 12, this chart really tells you why right now is a great opportunity. It's great to have really key points like that are supported by graphs, charts, tables, whatever. So I think it's really critical for people going into those meetings to know their material and know where to go to hit home on the right and maybe most important points.
Is it typical that you'll do a bunch of meetings and then if you go to, so to speak, close a meeting that you have to bring in somebody from the investment team and you've warmed the oven and then they come in pretty cold? Is there any advice that you can give to people to help navigate that? Because every PM is a little bit different.
Well, look, I believe in preparation big time. So I don't want anyone to go into a meeting cold. If possible, I'd rather before the meeting that there's a pre-meeting and that the relationship manager is explaining to the participants in a meeting, here's the history, here's what's going on, here are the concerns the client has expressed, here are the things that I really need you to deliver, the messages I really need you to get across, here are the things you should avoid. Whatever it is, I want there to be an opportunity for preparation so that everyone goes into the meeting as much as possible on the same page and ready to row together.
What else at Oaktree is going on? You hinted at these management precepts. I'm curious to learn more about what you were hinting at.
Well, I appreciate the question because I love the topic of management and leadership. And I consider myself a student of management and leadership. So I have some gurus out there I've followed. And what we've done is, at least in my department, my management team, we've developed a set of management precepts or principles that we think should govern how we manage people. This is different from leadership, by the way, but how we manage people and how we want our managers to manage. Really, the 6 key things we think go into great management. So the first is hire the best people. And that sounds really funny to start with that. But really, I tell people, if you hire the right people, most everything solves itself. Not everything, but most everything. So hire the right people. And for us, that means finding people who share our core value of continuous improvement, people who have the excellence bug. That's really, when I think about the best people, is I think about athletes with a mindset of excellence. So that's principle number 1. Number 2 is to set and communicate clear expectations. And people forget to do this, but if you do it at the beginning, when you don't even know somebody, it's not personal at all. It's just, hey, here's what we expect. And not just what we expect, but how we expect you to do it. The collegiality that we want you to do things with, the partnership mindset we want you to do things with. And here's the bar. Here's what it looks like to do it the way we need you to do it. And that's so critical because if people stumble, and they will, it's so much easier if you can refer back to the expectations. So if somebody's just not quite hitting the bar, at least they know where the bar is. The worst is if you get into a situation where somebody's underperforming, but they really don't even realize that they're underperforming or that somehow they're not meeting your expectations. So setting and explaining the expectations up front is critical. So that's principle number 2. Number 3 is deliver feedback as a gift. And I have a coach who once taught me this, that if you give feedback to somebody as if it were a gift, you're giving them something good for them, something that's precious, that if they take it on board can make them more successful, then it's a gift. Why wouldn't you give it to them? A lot of managers shy away from feedback because they don't want to hurt someone's feelings or they don't want to offend or make somebody feel inadequate. But if they change their mindset and they think, if I tell them this, it's going to make them more successful, then why wouldn't you do it? The key that unlocks the cabinet of success. So if success is like an apothecary cabinet with all these little drawers, maybe 100 different drawers, and that's a lot, but let's say that, and you say, I see you're doing this one thing. And if you just would adjust it like this, that's going to open that cabinet of success. So that's the spirit in which feedback has to be delivered as a gift. Principle number 4 is, as managers, we need to build positive relationships across the organization. So people like to work for people who aren't just respectable and likable, which are qualities to be respectable or likable, but they want to work for people who are actually respected and liked because those people tend to have influence. They've tended to build bridges that their employees can walk over and get things done more readily and make it so that people want to work with you. So that's really important that the manager invests time in building their own relationships across the organization. The 5th is about balancing the importance of relationships and results. So a coach I worked with about 15 years ago once said to me, are you a relationship manager or a results manager? And I didn't really know what he meant, but what he was getting at is that most people tend to manage with results top of mind or with relationships top of mind. So you've probably met people who are real results drivers and they ram through people's feelings and considerations. They want to just get it done at all costs. And then you've got people who are so focused on relationships that they're really all about their people's well-being and making sure they're not working too hard and making sure they have all the support. And both these things are incredibly important. My view is that great managers don't necessarily lead with one or the other, but know when to fluctuate between the two. If you think about it as a spectrum, obviously it's the best possible thing to be balanced, to always be reminded that this is not a nonprofit here. I'm not doing this just to make people feel great. I'm here to make sure we get things done, that we advance our business, but we get our business done through people. And so people are everything. But you have to know when to put one maybe a little bit above the other, when to balance and recalibrate depending on what's going on in the business and what's needed. So that's really critical. And then the last of our 6 precepts is that we want to invest in and celebrate success. When you invest in someone's success, whether you're a manager or not, but typically our managers are obviously spending a lot of time mentoring and training and developing and providing opportunity and so on, there's a little bit of a rising tide lifts all boat effect. I always say, gosh, I know I'm really successful at Oaktree. It's because my people are successful. They're doing such great work that it reflects well on me. So we want the managers to really make sure they're investing in others' success and then celebrating it. I think sometimes we forget that last part, that it's not just about getting the wins, but making sure when the wins occur that people are acknowledged for it and that there's time to do the pat on the back and celebrate it.
With all those precepts, which I think are really, really helpful. If I'm a day one employee, that's really powerful. What makes a really good employee to walk in the door? And you have to adopt that, but what's success look like at Oaktree on an employee level?
I mentioned the excellence bug. People who are always looking for a way to improve. And by the way, when we interview people, the way I look for that is, how curious is this person? Do they have a tendency to overachieve? I like that. I like overachievers. And in all areas. If someone's been really, really successful at one thing, that's great. But it's even better if they've been really successful at a lot of things. And that might manifest in their academic life, their personal life. It doesn't just have to be their professional life. But when somebody likes to be good at a lot of things, it tells me that they're interested in a lot of things, or they can sink their teeth into a lot of different subject matter and perform. So I look for people who are intellectually curious, who like to overachieve, who like to get great results. And in that case, people who are athletes. So it's not just finding the best quarterback, but somebody who can be put on almost any position on the field. Obviously, for some more senior roles, you need somebody with more specialized expertise. But in general, when we're hiring, say, at a junior or a mid-level, I'm really looking for athletes, people who can perform in a lot of different areas, again, who are very high achievers, who are intellectually curious. And obviously, again, culture is so important at Oaktree. I know it's important for most companies, but it's really, really important at Oaktree. So what I like to say is if we hire people who share our values, that will perpetuate the culture.
Nicole, this has been really insightful. We would like to close with 2 questions. One question is, what advice would you give to an emerging leader?
Know your management style, know your weakness, know your blind spots. Always be willing to be introspective and invest in yourself to become a better leader. None of us that's been doing this even for a very long time is doing it perfectly all the time. We always have room for improvement. So I think invest in yourself, understanding your leadership style and how it can be improved, and really gather feedback along the way as you grow as a leader. Those would be my advice. Then if you're an emerging manager, developing your operations and your investor relations regime and whatnot, I'd say build for scale, integrate technology early on. And if you're early in the life cycle of a firm, hire athletes. Don't get too hung up on hiring people with precise experience. Go ahead and find people who can stretch, who are high performers, who can really help you build great organizations.
And then the other question is, what one book, article do you often recommend to people?
I'd say the resource I'm most high on for anyone joining this industry is the Wall Street Journal. If you're not reading the journal, at least the headlines on a daily basis, you're missing the picture. It's such a fantastic resource.
Good stuff. Nicole, thanks for the time.
Thanks so much, Scott. This has been great.
Thanks for listening to the show. If you like what you heard, hop on our website at capitalallocators.com, where you can access past shows, join our mailing list, and sign up for premium content. Have a good one, and see you next time.